Moving on to our topic 8, Readiness for Equity Investments. Pre-seed. The best sources for pre-seeding is family and friends. The most convenient and easy way to reach pre-seed funding is through family and friends. They mostly don't have trust issues for giving or lending money. They offer small amounts of money for the startup idea, mostly not expecting any return. The founder of the startup up at this stage may not have a complete business plan or any proof of value such as initial orders for stock. Convertible loans. Convertible loans are loans which are to be converted into equity when valuation is gained for the startup. For this purpose, the investor and the investee will negotiate a trigger for conversion of loan into shares. This will be on the agreed future date or on the equity qualifying round. The trigger can be on the liquidation and sale of the startup or the change of control of the startup. The investor here wants the threshold amount, the given money by the investor, to be high enough that when it converts to equity, the value return be high. The third type of pre-seed investments is convertible note document. The convertible note is a way for seed investors to invest in a company that is not ready for valuation yet. They start as short-term debt and then in future be converted to shares. The convertible notes are automatically changed into shares once a threshold is crossed. Y Combinator SAFE can be a good option for this purpose. Y Combinator introduced SAFE Simple Agreement for future equity for this purpose. Simple presentation deck and company bank accounts are furthermore options and components of pre-seed investments. Moving on to the second element of readiness for equity investment, seed and launch. Best source are angel investors. Angel investors are the type of investors who are focused at financing startups or small capital ventures. They, unlike venture capitalists, use their own network for investing, whereas the venture capitalists use the investment funds. Angel investors provide funds as convertible debt or against equity. The main reason for calling them angel is that they provide finances to the startup when no one else is ready to back them. The other types are convertible loans or shares. Convertible loans and shares or equity are a good way of getting finances for a startup company. But there is a slight difference. Convertible loans are offered to the startup with an agreement of giving them equity in future, as usually these loans are not intended to be returned with interest as banks do. Instead, these are provided at the time of pre-seed and seed stage with a commitment that the loan will be converted to equity and given to the financer. Whereas finances against shares or equity are given when the product is ready to be launched. The finances given against equity determines the valuation of the startup. The further tools to raise investments in seed and launch are convertible note document, stock purchase agreement. The convertible note is a way for seed investors to invest in the company that is not ready for valuation yet. They start as a short-term debt and then in the future be converted to shares. The convertible notes are automatically changed into shares once a threshold is crossed. Stock purchase agreements or SPAs are transaction contracts for the sale and purchase of stocks. The primary purpose is to establish the price of the stock. These are required when companies purchase stock of another's company. Second, product to demo. When the startup has created a product, it's now time to demonstrate. In the beginning, the product may not be offering all the benefits at once, but this is the line to provide a tangible proof of your idea. The concerned customer gets the idea what he's going to purchase. The product demo is considered as a difference between closing a deal or losing a prospect. The best demonstration is the one which makes the customer see and feel how the things will be different when he will buy the product and worse if he doesn't. Moving on to a further description of seed and launch. Few customers in the loop. In the beginning, there are few customers in the loop. It means that there are a small number of customers using your product or service, but their feedback is very important. To keep their feedback is very important. To keep the customers in loop, you have to update them regularly about your products, taking their feedback and solving their concerns. Their feedback helps develop the product and in result getting more customers. The customers are the ambassadors of your product. Your product can become a word of mouth in the market or a failure in the market. This includes good customer services to win the loyalty of the customers. Good presentation tech and lean canvas and company bank accounts and NTN numbers are another source of seed and launch. One of the most important elements for readiness for equity investment is growth. Best source, venture capital. Venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have a long-term growth potential. Type of shares. Finances against shares or equity are given when the product is ready to be launched. The finances given against equity determines the valuation of the startup. Term sheet, stock purchase agreement. A term sheet is simply a list of the terms of which an investor or a lender is prepared to offer funding. Stock purchase agreements or SPAs are transaction contracts for the sale and purchase of stocks. The primary purpose is to establish the price of the stock. These are required when companies purchase stock of another company. Moving further towards growth, the growth of the startup is relied on furthermore three elements: product and customers, good presentation deck and financial projections, and company bank account and NTN number.